So now I'm going to move on to tips for success. Excuse me. Some of these things may be very obvious to you, but pardon me, I don't know the level of knowledge that you guys have in the audience today. So, one is there's a thing called test the waters. I actually suggested this in June of 2012 to the SEC that they allow entrepreneurs, CEOs to test market their company to see if it would be cost effective to promote in a raise situation without having an audit, without having an SEC filing, to make life simple. So that's called test the waters. We've trademarked that term in a number of interesting ways because we were there, we were paying attention. But the point is that you can cost effectively test market your company in order to see how it would fly. You can't raise money from that. You could take reservations that are non-binding, and later when you do the raise, re-engage with those people to invite them to invest. But when you're doing the test, of course, you can't actually raise money from that. There's two tiers of Reg A plus, tier one and tier two. It's almost always a bad idea to use tier one, so I'm not going to spend time on that. And we have a FAQ on the MSC site that goes into detail about why tier one isn't very useful for most companies. Avoid email lists. Of course, there will always be an exception in life, and we have one customer right now where their agency is taking an unusually different approach to emailing to a large list and having some success. And this is actually the first time that I've seen that in almost 8 years since I launched this company, Manhattan Street Capital. So in general, when you rent lists and buy lists of prospective investors, it all sounds great until you do the work, until you send the emails, and then nothing much happens. Uh, Email service providers have become more and more restrictive. Apple is inserting themselves into email delivery on Apple devices as well. But basically, I've just seen so many tests and so much wasted money and time. So in general, be very skeptical about the value of renting, buying a list. There are special cases, like our member base is a special case because we're dealing with them regularly and they're already investors and they understand the context. But in general, lists aren't very valuable. Include international because the SEC allows that. And as long as we have the payment methods in place, credit and debit card being the primary ones for international investors to engage, then that could be super because there's a lot of people in the world that are starved of great investment opportunities and would love to own equity in a US company or in a series offering in a piece of art or in a car or collectible watch. So international can be a very profitable place to market to. You're not limited to the US. So don't ignore the rest of the world. Avoid big auditors because they can't charge too much and tend to be so slow, sometimes remarkably, ridiculously slow. We've had experiences with that. So avoid, the big name auditors. They are wonderful in the right place. For giant companies, they can afford the expense and they love the blessing of having one of the big auditors on their books, as it were, as a provider of that service. But for the scale of the size of companies that do Reg A pluses, the risk is too expensive and the risk of ridiculous delay is terrible. Set a low minimum escrow amount if you can. If you're buying an asset, you've got to set the minimum to be what money you have to raise to buy the asset. But if you're growing your business and you write your Reg A Plus properly for that, then you can set a zero escrow minimum. That is to say, we'll raise money and we'll weekly, whenever we choose to, we'll do escrow closes and issue the share certificates to the investors. And set a high maximum raise because that gives you flexibility where you aren't limited later. If you start out planning to raise $18 million and then there's some good things happen and you make an acquisition and now you want to step up the raise size, not having to go back and requalify a larger raise amount is a luxury, right? So why give yourself that built-in limit, that limitation? Use a low per investor minimum because when we're marketing to investors, I say when our customers are marketing to potential investors through advertising outreach and so forth, somebody's doing something else and they see an ad and they like it enough that they click on it and then they arrive on the offering page. And if they like it enough and understand it enough and it's pleasing to them, then they may invest. But at the moment, it's a very casual thing. So if you give them a $2,000 investment minimum, most people will just leave and never come back. I mean, I've seen higher. I've seen $5,000 investment minimums, which are the kiss of death in a retail Reg A plus. If you're only bringing in accredited investors, then why would you do it in a Reg A plus? You may as well do a Reg D offering. But that's important because at that point in time, it's a casual engagement. Now, they may invest a modest amount initially, but then they're on the email list for updates and they're visiting the offering page, and you're conveying updates to them and making it more and more interesting and building credibility through the success of the raise. Then people will come back and invest more, and then sometimes they'll come back with their managed IRA and invest a lot more. But we would have lost them at the beginning if there was a $2,000 minimum, for example. I mentioned this earlier, but you can change the valuation and the share price of your company during a Reg A plus, which is a lovely thing because you can reward the earlier investors who took a bigger risk, because at the beginning it was more risky than it is at the end of a large raise or even a small raise, right? So you're rewarding them for being risk takers. But when you make a modest share price increase and announce it in the proper manner and the right to the right audience, which is regulated by the SEC, then you're reflecting the fact that people could have taken a risk earlier and chose not to, and you create genuine, legitimate rarity value by telling people that on Thursday at midnight the share price is changing. If you do it in the right manner, the right language, then that can be very helpful to nudge people from spectating into actually investing. A couple more tips. FINRA, the regulator for broker dealers, is very slow. So bear that in mind when you're making your plans. You don't have to use a broker dealer, but if you do use one, then you are dealing with FINRA. So getting all the ducks in a row filed very, very early is a valuable thing because of that. And of course, marketing is key. It's all about marketing communication of one kind or another.